So I've talked about levels, about how you would trade certain levels, and a level can become quite arbitrary. Ultimately, the level is drawn by you. You may say that the level is at 81s. Someone sitting 2 desks down from you says the level's 77. Who's right, who's wrong? This is where levels can trip you up a little bit because of the fact that they are entirely decided by yourself. Indicators are not. If you have an indicator, if you put a 200 period moving average on a chart, then the 200 period moving average is the same for everyone looking at that chart. So what they do is an indicator gives you context. That's the most important thing. So it can inform you whether a level is strong, whether a level is worth trading. You could have a big level that you've been looking at for a long time, but come the time that it gets there, if the indicators are also not matching up, then your level is perhaps not as strong as you initially thought. So a few things to be thinking about: how the market approaches a level. This is very important. If a market grinds to a level, then what it's showing you is that there's a lot less chance of that level holding. It has just ground its way through multiple levels. Whereas if you get a fast move to a level, this is often a scarier move. It is a trade that you're not necessarily going to want to take because you sort of see it come down and you think, wow, I don't want to buy that. Look how much the market's moved. But these are often the ones where it will react. And so a level becomes stronger based on the way the market approaches it. Once again, where the markets come from as well. If your market is open 5 ticks above a level and it comes down to it, it's starting to look a little bit less strong because of the fact that the day has only just begun. There could be quite a lot more range expansion on the day, and so for that to be the low or high of the day within 5 ticks of the open is often not always the case. Again, think of this in the other side, that if the market has already had a huge move, then a decent level that it's moving to then can become quite a lot stronger because of the fact that markets generally will always keep to around about the same size moves on most days. Of course this can extend, and we will see examples of that coming up, but in general, if the market has moved beyond what is a normal range, then levels do start to become a little bit stronger. So where do these indicators come in? They are either going to give you an idea of whether the market has done too much, too little. You're going to get clear areas that are going to be watched by multiple people. These indicators are the same for everyone that puts them on. There is some variation, and I will show you this on some of the indicators coming up. They're going to give you a chance to put a trading stop in. This is often one of the hardest things to do, to decide where to have a trading stop. But if you've got an indicator, particularly one that continues throughout the day, I'm thinking VWAPs, moving averages, then it gives you an idea of where you could put a trading stop. You could have it below the indicator, and that gives you an opportunity to stay in a trade, to sit with something. And also, as I say, it gives you a gauge of strength of the move. So let's go and have a look at the first indicator, Bollinger Bands. Now, a Bollinger Band is a volatility indicator. What it does is you have a 20-period moving average, here, this blue line, and you then have bands outside it which work on a 2 standard deviations from the Bollinger Band. So that is these red lines here. So you have one above, one below. The idea, as I say, because it is a volatility indicator, is that as the bands expand, volatility is increasing. As the bands contract, volatility is decreasing. So if we look here in the oil market, you can see that volatility has increased in this area here, and that has been indicated. Really, you've had this large move up over here, and then you've seen a bit of volatility continue. We have, as I pointed out earlier, another candle just here as a shooting star for you, which does call the high and is just outside the Bollinger Band. After that, you're then seeing range contraction and this consolidation here, and the bands are becoming a lot tighter. So that's what it's giving you an indication of. How are you going to use this for a trade though? And that's going to be the key thing. Now, there's a few different ways to look at them. There's the idea that you can just buy the lower band, sell the higher band. I'm not entirely that keen on it. I use the Bollinger Bands more to give me an idea of the strength of a level, or to make a level stronger or weaker going forward. So if we are outside of the Bollinger Bands, you'll then get into a point that the market would consider overbought, oversold. So once you're outside, you're then thinking in terms of, is there a level that I can get in on that's going to draw the market back inside? Now, they can stay outside for quite a long time, or they can sit around the lower bands or the upper bands for quite a long time. We've got a good example here on an hourly chart where we do stay outside for quite a while, and once again to the upside. So they will stay outside for quite a while, but then once you start getting back within, as you can see on both of these examples, you do then get the move in the other direction, beginning here and again beginning down here. So that's one way of looking at it. As they start coming back in, you are then looking for a move back towards the middle band, just here, and eventually you get it here. So it does take time to move back into them. My favoured trade with a Bollinger Band, however, is a move to a steep band. If the band is become very steep, in this example here, the band's moving down very steeply, a move back to it, I often find, is a very good entry on a trade. And that's how I tend to use the bands. You use it for a swift move and a swift move towards a very steep band. If you are looking at it, say, in this area, any swift move to a band for me would not be a move that I would deem worthy of a trade. However, if you get a swift move towards a steeper band, i.e. down here, after we've been quite a long way away, it didn't reach it, I do know, I can see that, then that's where you're going to be looking for a trade. Once again, you've got this area here. You can have a go at this trade. Your stop is going to be above this most recent high. So obviously your stops are a little bit more discretionary in terms of you've got to pick the stop. There's no sort of way of really clearly defining the stop. Again, if you bought the move to this steep upward sloping middle band, then your stop's going to be below this low. And the number of ticks, again, always depends on your market. And of course, once you get in at the bands, you're looking generally for a move to the next band. So again, if you're in here, you're looking for a move back to the top band. And likewise, if you do it on the extremes of bands, then you're looking for a move back the other way. So we've got a nice little example of this in the oil. First off, got this on a 15-minute chart down in this bottom corner down here. You got a flag, the flag breaks, and then we get a continuation lower. Now, what you're seeing is, as this continuation happens on this chart, you're getting this move down here. We're getting right on the edge of the Bollinger Band. We're starting to move outside the bands down towards these lows. And that's partly why the flag doesn't actually reach its target, because the market is getting a little bit too far, a little bit beyond itself. And there will be people who are actioning trades as we start moving outside of the Bollinger Bands. And that is what's going to suck the market back higher. As you can see, you're also moving outside the daily band as well. So once again, quite a few reasons why people will be entering the market and trying to buy it back. So what happens is the flag fails. It fails to reach its target. You get these couple of rejection candles, these two here. Both times long wicks on the candles, price is rejected, moves straight back up into the range. And you then see this impulsive candle higher. Reason for that is people have finally started giving up. You get new buyers come in the form of shorts getting out of their trades, but also once you've got the move back above these previous lows coming in at 52.36, you start getting more and more buyers coming back in to try and push the market back higher. So what are you then thinking? All the time you will have been looking on your hourly chart, your bigger time frame charts, and this would have come up as quite an obvious level, these 59.92. So you've twice seen the market come down, dip to it, and hold around the 52.92 area. So immediately you're thinking, right, that could be a level that I want to have a go at trading. Now, if we had stopped just here and moved back to it, it may not have been quite so strong. However, we've been quite a long way away from it. We're now moving back. As we mentioned earlier, remember, levels can become more of a zone than just a level. So you've also got these couple of lows just here, 53, 02s to 05s area. So you've got around about a 10 to 15 tick range on that actual level. So what we see is the market charges back up on the 15 minute. This one move in 15 minutes takes the market a full 60, 70 ticks straight back up to the middle Bollinger Band here. That's your clue to have a go at selling it. Yes, you may wish to scale into the trade, so you could have some sales at the 92 area. So you get short there, but what you've got to be thinking is the market has got to get beyond that middle band. It's got to get beyond these 03s, 04s to actually get you out of the trade. So be aware of that as it's coming up. You'll be able to see the market slow as well on these impulse moves. That offers you the sell on the steep band, and then you're looking for the move back lower. Now, once again, remember that the market has already been outside of the band, so we've already had quite a big range. You're not necessarily looking for a new low, but what you are looking for is a bit of a pullback. So your first target is going to be this high at 68, and then you're looking for a move back into this range. And really, that's where you're going to be looking to be starting to take some of your trade off. And I would be looking, really, my main target back into this area here, where you've got quite a bit of volume done, and ultimately these 36s. Anywhere beyond that, I think you're then starting to be looking at a bit of a bonus trade, but ultimately the back to the lower bound of the Bollinger Band is going to be the bigger term trade in that. So that's how I like to use Bollinger Bands. It's more something that makes a level stronger as the market comes back to it, as opposed to just an idea of whether the market's getting a little bit too oversold, overbought. One last thing as well, just to point out, once again, flag retest works very nicely. So you've got multiple reasons to be selling the low 53s, high 52s. You've got the flag retest, you've got the levels from 52.92 to 53.03, and you've also got the Bollinger Band. So when things start adding together, this is what makes a market a lot stronger. Let's have a quick summary. Bollinger Bands. It's a volatility indicator. The moving average in the center is a 20 period, and the bands outside are 2 standard deviations away. In general, an expansion of the bands gives a range extension and a tightening of the bands. You're looking for smaller ranges, but what you've got to be thinking then is you're going to be looking for breakout opportunities. Wait for them, of course, but as you start seeing the markets start to turn, the bands will then begin to turn, and that's where you get the volatility picking back up. If the market should be starting to get outside of the bands, again, any moves back in, any opportunities to play the market back towards the range, sort of a mean reverting style trade, you're looking back to the middle band. Any fast moves to a steep band off a good trade location, and levels outside the bands increase in strength.